Welcome to our Taking Stock video for the week ending the 14th of June 2024. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Senior Equities Analyst, Jason Yin, to stream to you all things share market. Welcome, Jace. How are you on this cold winter's day?
Very, very good, Ken. Try my best to stay warm, staying on front of the fire.
It's very hard to stay warm these days, especially with the high energy costs. But before we get started, just a quick yet important reminder. The information we provide today is of a generic nature and therefore shouldn't be considered as personal advice. Remember, shares are volatile, so any past performance figures shouldn't be relied upon as a guide for future performance. Well, Jace, there's been a divergence between the performance of US stocks and those in Australia. The US market has hit new highs this week, while the Australian market continues to consolidate around the same level since March this year. So, what has been driving this disconnect?
Yeah, that's a pretty interesting question, Ken. Since late last year, markets have been driven by optimism around interest rate cuts, and this is widely expected in the US, which is predicted to cut interest rates much earlier than here in Australia, where inflation appears to be more sticky. In fact, if we were to look at the US market, analysts are actually predicting a 60% rate cut by September this year, but in Australia, a rate cut is not expected until mid-2025. So as you can see on the chart on screen, this shows the cash rate projections for both of our markets.
Yeah, it looks quite interesting, doesn't it? And one of the drivers for the difference in the interest rate projections is inflation, of course. In the US, inflation for May came in lower than expected, with the core CPI, which excludes food and energy costs, running at an annual pace of 3.4%. And this has helped propel the US market to new highs this week. However, in Australia, though, core inflation for the year to April has been stabilizing at 4.1%. And with stimulus measures such as tax cuts expected to start flowing through from next month, there is a risk that inflation in Australia will remain sticky for some time.
And also the other distinction between our market and the US is that the Aussie market is driven by cyclicals such as resources and the banks, while the US is more weighted towards technology and healthcare stocks. And who can forget that technology stocks have rallied on the excitement around artificial intelligence, along with expectations that interest rates might decline.
Yeah, and speaking about resources in the Australian market, Jace, we noticed a significant sell-off across the mining stocks this week following steep declines in the iron ore price. It looks like analysts have been downgrading their iron ore forecasts on concerns over the weak housing market in China.
That's right, Ken. The latest move comes despite China unveiling a set of stimulus measures in May to encourage more home buyers. In addition, inventory levels at Chinese ports are at their highest in more than 2 years, and this could suggest that steel demand could also be rather weak.
And within the resources space, we currently have one company now exposed to iron ore, and that is Star Growth Stock Mineral Resources. But the impact to earnings for MinRes, that's expected to be limited given that its exposure to iron ore only represents about 10% to its total profits. However, we previously also had some exposure to iron ore with our ex-Star Income stock, Deterra Royalties.
And that's right, Ken. For Deterra Royalties, its revenue is based on a 1.2% royalty fee on realized iron ore sales, and the decline in the iron ore price is expected to lead to lower revenue, assuming volumes of sales and currency impacts remain constant.
Yeah, and although its forecast earnings have only been revised slightly lower through the earnings revisions, the actual overriding issue here, Jace, is that Deterra decided to make an acquisition of Trident's royalties from their existing cash reserves and some debt. Now, the cash flow benefit from the acquisition is not expected to materialize in the near term. And due to the change in their dividend policy and also the cash flow dilution from the acquisition, we have decided to cease coverage of the stock as our Star Income stock. So Deterra Royalties, it's currently on a forecast gross dividend yield of 10%, but this yield will now be impacted. And while we're on the topic of commodity companies, small tier gold miner Alkane Resources reported a production downgrade during the week. What do you make of this, Jace?
Well, the company is currently going through an expansion phase of around 60,000 ounces of gold, and they're hoping to increase this to 100,000 ounces. However, with many mining projects, the ramp up is actually taking longer than expected. We did notice that management stated that a 5-year production plan will be released shortly, and this will give us greater certainty around its future cash flows, its earnings, and also its return on capital.
Yeah, and for now, we have retained Alkane Resources as a star growth stock. And with the stock trading at a steep discount to valuation, it could represent an opportunity for some investors, as long as they are comfortable with the risk, including the volatility in the gold price, which can lead to uncertainty around those forecast growth numbers. In the markets this week, there has been a lot of buzz surrounding the IPO of Guzman y Gomez, which is a hip Mexican eatery. Despite the funfair, some investors have flagged their concerns around the proposed IPO price. Jace, to start off with, can you provide viewers with a quick overview of Guzman y Gomez?
Well, Kien, the company is a Mexican-inspired taco and burrito selling restaurant, and it's one of Australia's fastest growing quick service franchises around, with 200 stores in Australia, several in Singapore, Japan, and also in the US.
Well, that sounds impressive, Jace, but can you tell us a bit more about their business model and how it works?
Well, Guzman y Gomez has actually adopted a hybrid restaurant ownership model, which means they completely and wholly operate some stores, whilst the remainder are actually owned by franchisees, from which they take a significant royalty fee. Management plans to expand the store count domestically to around 1,000 stores over the long term, and the current target being 200 stores in the next 5 years. They also expect to grow geographically and are an increasing brand awareness in also new markets.
Yeah, very interesting. It seems that they have an aggressive store rollout plan. Is this why the sellers have placed the IPO at a premium price? And how does the price compare to other fast food operators like listed fast food restaurant chains, Collins Foods, and also Domino's Pizza?
Yeah, and I think that's the question on most investors' mind over the last week or so, Kian. What price would you actually pay for a new and coming franchise or an IPO compared to some of the incumbents in the space? From Guzmani's Gomez's valuation perspective, it's a little bit hard to sort of gauge because of the lack of listed history, and also because management have adopted rather unique accounting standards, Kian. So, for example, the company has not included lease payments within their calculation of EBITDA, which effectively stands for earnings before interest, tax, depreciation, and amortization. And thus, this makes this figure, EBITDA, a lot more attractive than what it actually is. If we were to back out and include some of these lease payments, then this would bring the FY24 EBITDA down to $26 million, and thus translates to an FY24 enterprise value to EBITDA multiple of actually 75 times.
Wow, Jace, that seems quite high and it's very technical. And it also reminds me of Charlie Munger's quote: every time you see the word EBITDA, you should substitute the word for bullshit earnings, Jace. um,
Yeah.
but how does this compare to peers within the industry?
Good question, Ken. We had a pretty close look at the prospectus and present the following financial metrics compared to those listed, such as Collins Foods and Domino's. So as you can see, Guzman y Gomez is expected to achieve double-digit revenue growth in FY24, and this far exceeds the growth forecasts for Collins Food and also Domino's Pizza. Interestingly, however, at an earnings level, Guzman y Gomez has a comparatively low ROE and also net profit margins. And this could be indicative of their aggressive store rollout plan and also high costs associated with the IPO. From a valuation standpoint, Collins Food trades at a forecast FY24 PE multiple of around 17 times, whilst Domino trades at around 28 times. And if we were to contrast this to Guzman y Gomez's PE of 655 times, it just makes everyone scratching their heads going, what's actually going on?
Yeah, that's incredible. Even more expensive than Pro Medicus. That's quite a stark difference there, Jace. Given these comparisons, do you think that Guzman y Gomez's IPO price is justified?
Look, high growth rates deservingly receive higher multiples. And of course, Guzman y Gomez anticipates a doubling of their store count in 5 years. So the implied compound revenue growth rate is around 15 to 20% per annum over this period, which is actually quite attractive. If management can achieve this level of growth, then the company will have a similar national store count to that of McDonald's. So we feel if they can pull it off, then the price premium could be justified compared to Collins Food and Domino's. However, Kian, if management can't pull this off, then shareholders might have to deal with a lot of sour leftovers.
Yeah, good points, Jace. However, from a stock doctor perspective, though, we won't be able to consider the coverage of this stock until it has 2 periods of strong financial health, which is currently quite unknown. In addition, it will need to ramp up its profitability because its return on equity and net profit margins are quite low. So members will need to consider these factors along with other risks such as its high valuation before considering the stock. With the end of the financial year approaching, a useful question for members this week is, how can Stock Doctor help investors with their tax reporting?
Well, the portfolio director can help clients monitor the stocks in their portfolio, which provides performance metrics and also useful reports. But no matter how good a tool is, Kian, there is always a level of input required from the user. So the first step is to ensure that your holdings accurately reflect your broking account. And this can be accomplished under the Securities tab. Down below, you'll also see your dividend payments, which are automatically generated by Stock Doctor. But it also pays, and excuse the pun, to double check that the amount is correct.
Yes, and you can also view your income and capital gains or losses by clicking on the Report tab. The income section that links each amount to a tax return label reference to make the process of filling tax returns a lot easier. And the capital gains section will reveal any gains or losses you have made during the financial year, including the option to bring forward any capital losses from previous years. Under the reports, you can also see your historical transactions and portfolio returns.
And to generate reports for your accountant, simply click Save to PDF or Save to CSV, but make sure you select the correct date range. For the other asset classes such as cash, bonds, or property, you can refer to cash and term deposits and also other assets. This will ensure the calculations for your entire investment portfolio is accurate.
Yeah, thanks, Jason. We hope our members find that useful. Well, that's all we have time for today, and it's always great to have you on the show here, Jace, providing your unique insights into stocks.
Well, it's always a pleasure, Ken. And if viewers have any questions about today's episode, feel free to participate at our Lincoln Live session, which happens every Monday.
And time certainly flies, Jason. With the end of financial year fast approaching, it may be a good time to introduce Stock Doctor to your family and friends so that they can take advantage of our end of financial year promotions. You can either do this by the Refer a Friend tab or send them a link to the free trial page. In the meantime, have a happy, healthy, and prosperous week ahead.